Hello, this is Matt on the Moon Family Sedan channel. It's a known fact that there is a coordinated attack on all things crypto from various government agencies from the top on down, completely hammering the entire industry. But now we have a congressman, Tom Emmer, who is fighting back. And he happens to be pro-XRP, by the way. In fact, I'll point out here right at the outset of the video, and I don't need to read this article. I brought it up just to make the point, though. This is from August 21st, 2020, from Cointelegraph. The headline, XRP is not a security, argues U.S. Congressman Tom Emmer. And so this was months before the SEC sued Ripple, claiming that XRP itself is a security. And here you can see an actual quote from Congressman Tom Emmer, which is as follows, quote, "My position is very clear. XRP is not a security," end quote. So this guy's a massive ally. And he's bringing the fight back to the people that are pushing back against all of us in crypto, frankly. And in this case, he's pushing back against the FDIC. And so I'll share with you the specifics on that. But he filed a letter just this morning, just this morning. And it is nice to see that there are some people in Congress actually out looking out for people in the industry, from the people like us who are the speculators to the developers, any sorts of entrepreneurial endeavors that people are undertaking. It's good that there are some allies there. Now, I'm going to first set the table before getting into some of those specifics, though, because in theory, things could get very, very bad. Take a look at this headline from the Daily Hodl, and this is obviously on the topic of all of the recent bank failures that we've seen. Three banks supporting crypto just went belly up. One of the banks, Silicon Valley Bank, it was the second largest banking failure in history. Another bank, Signature Bank, was the third largest banking failure in United States history. These are massive deals. And so here's the headline from the Daily Hodl. U.S. banking system nursing over $600 billion worth of unrealized losses, warns macro guru Lynn Alden. Folks, $600 billion in unrealized losses throughout the legacy financial system, banks, everyday banks. And is this something that's going to prove to be problematic? Well, that's what I want to talk about. But before going further, I do want to be clear, I do not have a financial background of any kind. I'm not offering financial advice, and you definitely should not buy or sell anything because of anything I say or write. I'm just an enthusiast who enjoys making YouTube videos about crypto-related topics, but just as a hobby and just for fun. Now, I came across this tweet from TXMC, who was previously with Glassnode. And I'm a big fan of Glassnode. They do all sorts of on-chain analytics. Over the years, I've highlighted stuff from them a number of times. I think they do good work. And TXMC tweeted out early today the following. "Not sure why this has to be said, but it does. A Fed that is forced into cutting rates this year is not bullish." And so I wanted to kind of break that down just a little bit. The Fed, as you well know, has been increasing interest rates since last year, the beginning part of last year. And that was in an effort to tamp down inflation. Inflation has just been completely out of control because for years after the pandemic, with the trillions of dollars that were literally printed into existence, too many dollars chasing, whatever goods, too few goods. It's a recipe for inflation, obviously. And well, we've all seen the consequences of that, right? And it was something that was obvious. It was something that was very foreseeable, but still, government did what it did, completely devaluing the United States dollar in terms of purchasing power. And so what does the government then do? They raise interest rates in an effort to reduce economic activity, because the higher interest rates are, the less likely entities are willing to take on interest, whether it's on a personal level or for any sort of business endeavors. The higher the interest rate, the more you're going to turn off people and businesses. So that's what they've been doing. They've been tamping down inflation by increasing interest rates. So if the Fed is forced into cutting rates this year, well, why might they be forced into cutting rates this year? Well, think about this. What has happened with the banks collapsing? What has happened here is there are a bunch of banks, and I'll get into the specifics because that article covers it very well, as I've been covering, and I've been talking about this topic for a number of days, but we're just breaking it down further now because there's new information that's come to light. But, these banks, they have all sorts of unrealized losses. Why do they have unrealized losses? Well, because they took customer deposits, and this is totally within the confines of the law. They didn't do anything illegal. They took deposits from their customers, and invested it into government bonds, which is considered to be, typically among the safest of investments, right? And it is actually, in theory, it should be anyway. But a lot of these bonds were long-term bonds that were purchased at very low interest rates. So as you increase interest rates, what happens? The bonds that are at lower interest rates, there's not as much of the market for them anymore. So it's fine if you carry them to maturation, then fine, you get the full amount out. But what if you are forced to liquidate? What if you have to sell now if you're a bank? Well, then you have to sell at a discount because the newer bonds, they're paying a higher interest rate. So some of these banks, like for instance Silicon Valley Bank, they cater heavily to tech companies, and as a result of catering to tech companies which have been hit hard recently, they had a lot of their customers pulling money out. There was a bank run. They didn't have enough funds on hand to give it to all their customers, so they had to liquidate the government bonds, but they had to do that at a loss, which leads to insolvency. That's effectively what happened here. So now we know that there's, again, $600 billion, that's what's being reported, in unrealized losses. Meaning if the banks that hold these bonds, if they were bank run, if they had to sell, they would become actual losses at that point, and that would be a problem. So the theory here is, the concern is, that if the Fed, they actually might pivot sooner than later. That's the fear anyway. And if they pivot from increasing interest rates to either just pausing or even decreasing the interest rate, well, then perhaps you have less of a concern in terms of unrealized losses becoming actual losses. In theory, maybe you would over time, although you can't even do that overnight. You have to tamp down, roll the interest rates down over time. But even if you do that, then what continues to happen? Well, then inflation continues to spiral out of control because the inflation problem hasn't been fixed yet. So you see the dilemma here, right? It's one or the other. You're stuck. They're completely stuck here. And so that's why when he wrote here, a Fed that is forced into cutting rates this year is not bullish. Exactly. It's not bullish. And I'm sorry if that was too long of an answer, but I want to make sure I give all the details. It's not bullish because if the Fed is forced into that, then inflation is going to continue to spiral out of control. And then, in fact, it's equivalent to quantitative easing then, because the money's it's going back to depositors. I mean, it's going somewhere, right? It's the opposite of tightening, obviously. And so then there's this from the Daily Huddle. A U.S. banking system nursing over $600 billion worth of unrealized losses, warns macro guru Lynn Alden. So I want to get to the topic of, even though this is true, is it something that we should be fearful of? I want to talk about that. So let's go through the article. Popular macro strategist Lynn Alden is warning investors that the U.S. banking system is sitting on hundreds of billions of dollars worth of unrealized losses. In a fresh installment of the Macro Guru's newsletter, Alden explains how the current banking crisis is different from the one witnessed in 2008 when the U.S. housing and financial markets triggered a global recession. According to Alden, banks today largely invested in U.S. treasuries or bonds between 2020 and 2021, when the government introduced fiscal stimulus and the Fed kept interest rates low. These fixed income securities are generally considered much safer than the subprime mortgages the banks held nearly 2 decades ago. I'll just pause and note, not only are they considered to be much more safer, they absolutely are more safe. It's like night and day. It's not the bonds themselves that are the problem. It's that you have the Fed that has increased the interest rate, making those what normally a safe purchase. The government's good for it, right? In theory, that's what's considered safe. But then they created a market. They completely destroyed the market dynamics, because when you increase interest rates and you can get more out of the newer bonds, in terms of interest being paid out, well, that makes the lower interest rate ones that the banks had already put the money in much less desirable. And so if you're going to sell now, you have to put it less. So the only way this is reason this would be a problem is if banks actually are put into a situation where they'd have to sell. So some people are freaking out about this, and I'm just sitting here like, okay, let's calm down just a little bit here. I mean, fine, if there are a bunch of bank runs, yeah, we'd actually have a serious problem, but why would that happen necessarily? I'm not saying we won't see more bank failures in the short to midterm. I'm not even saying that. I don't pretend to know for sure. But if there are specific types of banks that cater to specific industries that are having hard times, well, any bank in such a situation, if they have a lot of depositors' money invested in government bonds, yeah, you're going to see more bank collapses probably. That could, but specifically just for them. It doesn't mean you're going to see this domino effect throughout all of finance like that. I don't see how that's going to happen. Why would you have a run on the bank outside of specific instances like that? And that's the argument. So, like, I see all the fear mongers out there, but I haven't seen a good articulation of why we should be fearful that we're going to see that, just nationwide and all the small and medium-sized banks. Why would that even happen? Especially when the Biden administration has made it very clear that depositors are going to be covered. Like that's, and they didn't literally state that for all banks, fine. But even beyond the FDIC, which covers up to $250,000, they've kind of set the tone, haven't they? In saying, hey, when it comes to what's happened with Silicon Valley Bank and Signature Bank, you're covered. That's the message that's been delivered. You think that's not going to expand? Because look, if you don't have that, the entire system collapses. So to me, it just seems like a duh. Of course they're going to offer that. Should you start to see additional banks fail? But then knowing that they're offering that, why would the rest of the banks have bank runs? No, seriously. Now, if somebody has a good reason, there's something that I've not considered, let me know. But I've read a ton of articles on this. I haven't seen a good articulation of why we should be fearful of that. I just keep seeing this number in the headline, $600 billion. Now, of course, if that happened and you see a bank run, like on a nationwide scale, well, don't forget crypto. I understand, like when the good news came out about, these depositors being protected, and okay, crypto responded favorably. But if you're talking about the collapse of the financial system, well, crypto, just like stocks, they're risk on assets. Given that they're risk on assets in times where people are scared, I think you should expect that they'll continue to behave like crypto's behaved in general for the last 14 years. Meaning, if you have a type of scary scenario like that, you're going to see prices plummet. That's what you can expect. And so this is all intertwined. This is highly relevant to anybody that's holding crypto, no matter what it is. And that's why I want to talk about this and kind of set the table here. It's also why it's absolutely crucial that we push back against this, which kind of brings us to Tom Emmer. Because, and by the way, I want to mention this too. I don't need to read this article, but just bring the point. There's a separate article here from Seeking Alpha noting that Bank of America, the second largest bank in the country, just behind JP Morgan, Bank of America has $114 billion in unrealized losses. And so they don't become realized losses until you actually sell. So it's the same concept as, imagine you bought XRP at 50 cents. It's currently worth what? What was it worth? 36 cents? Yeah, 36 cents. So if you bought it at 50 cents and it's currently 36 cents, you're sitting on an unrealized loss if you haven't sold it. It becomes a realized loss when you sell it, if you were to sell it anyway. And so right here, and so again, it's not necessarily a problem, especially when it comes to bonds, though, because you know what it's going to pay out, up to, when the bond reaches its maturation. So it's the end of the actual, loaning the money to the government, effectively, is what that is. And so you'll be fine, you'll be made whole, but it's only a problem now if banks are forced to sell because they're worth a lot less, given that all of the new government bonds, they pay out much better. So you would have to sell at a loss. But if you carry those through to maturation, I mean, yeah, it's not an enticing interest rate, whether it's 1% or 1.5%, whatever it is, it's a low interest rate, but it's not going to be a loss is the point. But if you're forced to sell it now because of all this, yeah, you're having a hard time then. So as far as Tom Emmer, and here's the headline from Decrypt covering this, Rep. Tom Emmer is the FDIC weaponizing market chaos to kill crypto. And it is a pleasure to see that there are some in Congress actually on our side pushing back against all this nonsense. And this gentleman on your screen right here, Tom Emmer, happens to be Pro-XRP. Piece reads as follows. U.S. House Majority Whip Rep. Tom Emmer is asking whether the Federal Deposit Insurance Corporation, FDIC, has weaponized its authority in an attempt to purge, quote, purge legal digital asset entities and opportunities from the United States, end quote. So look, he's not beating around the bush. This is written directly to the FDIC. And again, the quote was, he wants to know if they're attempting to, has weaponized an authority in an attempt to, quote, purge legal digital assets in entities and opportunities from the United States, end quote. Now, the fact that we're even in a position where it's reasonable for him to ask that is quite telling in and of itself. Piece continues. Emmer on Wednesday sent a letter to FDIC Chairman Martin Grunberg citing recent actions by the agency and accusations that it is trying to kill crypto. Emmer asked the FDIC if it had instructed banks not to provide crypto firms banking services, or if it explicitly or implicitly told banks they would face harsher supervision if they took on new crypto clients. Emmer also demanded to know what guidance the FDIC provided to financial institutions to help manage the risk of rising rates. And he said, quote, "If this is the case, these actions to weaponize recent instability in the banking sector, catalyzed by catastrophic government spending and unprecedented interest rate hikes, are deeply inappropriate and could lead to broader financial instability," end quote. And he's spot on. Like, why did a lot of this happen? Well, again, the government, in printing these trillions of dollars after the pandemic, it's just a debasement of the dollar. And so all of this money went somewhere, and a lot of the money was just thrown into tech. It had to go somewhere, right? And there's so much damn money, frankly. It's like, what do you do with that much money? And so, I mean, because it wasn't based on, some sort of actual real economic development. It was just that there was a bunch of money printing, which obviously would inevitably have the, again, very obvious outcome of inflation. But in the meantime, before the inflation actually hits, you just look like, whoa, it looks like we're way rich all of a sudden, except for it's not due to actual economic output. It's due to the printing of money. But so you put it somewhere, you feel like you got more money than God at that point. At times are good. That's what it feels like in the moment, right? But again, it wasn't from actual economic output. It's just an abuse of the dollar. And but if the money's got to go somewhere, so when it goes into the bank, where are they going to put it? And so a lot of banks, obviously, as you can see, to the tune of this point, $600 billion in unrealized losses. My gosh. But is it surprising? So the government caused that problem. They absolutely caused that problem. And then what do? To quote unquote fix the problem? They attack crypto. That's one of the things that they're doing. They're attacking crypto outright. And so, anyway, Emmer wrote that, citing recent comments by former Congressman Barney Frank, co-author of the Dodd-Frank Act. On Monday, Frank's, a Signature Bank board member, said in an interview with CNBC that regulators targeted the bank to send an anti-crypto message. So, and I mentioned that in a video the other day. He's not even pretending like it's something else. He's acknowledging, and he's anti-crypto, but he's acknowledging absolutely this is an anti-crypto message. And he also said that actually Signature Bank was solvent. And I don't know all the nuts and bolts of that, so I can't really speak to that. I'm going to look into more of that as the days pass and more information comes in. But his claim is that Signature Bank, what happened to it shouldn't have happened to it, and they were solvent. That's what he said. Don't know, though. Piece continues. In the letter, Emmer accused regulators of causing regulatory statement-driven fear, which led to a bank run on banks that provide legal crypto firms access to financial services. Emmer pointed to a January 3rd, 2023 statement by the FDIC, Federal Reserve, and Office of the Comptroller of the Currency, discouraging banks from dealing in crypto. Emmer requested that the FDIC respond to his questions by 5 p.m. on March 24th, 2023. So we'll see what happens. It's just nice to see something here. You got to push back against these people. It's just utter destruction and devastation. And for what? This is not justice. This is not right. All of these problems come from legacy finance. They come from the government. And who ends up becoming what ends up becoming the whipping post? Crypto. Everything crypto. This isn't right. This isn't justice. But this is what's happening. So anyway, I applaud Tom Emmer for pushing back against this crap. At least somebody's doing it. I'm not a financial advisor. You should not buy or sell anything because of anything I say or write. That would be a very, very, very bad idea. Until next time, to the Moon Family Sedan.